strategy issues in our analysis of fixed income securities. Before we begin, though, I'll point out that we will make use of another Excel workbook, this one called Bond Valuation, throughout this session as well as the next one. You may want to download it now to work along with our examples. Let's just kind of first remind ourselves of a few background pieces of information on where the bond markets fit into all of this as investors. Again, we've seen a chart now where this has become an old friend, perhaps, seeing this chart about how capital markets are actually organized. And so now we're looking at the lending markets. And let me focus on two dimensions of that: the so-called fixed income market and what are called floating rate notes or floating rate securities, sometimes called adjustable rate securities. And so we'll concentrate on more traditional forms of the fixed income market primarily over the next couple of sessions. We've already talked at some length about asset-backed securitization. And so let me look at more traditional ways of thinking about bond markets as far as how investors are going to look at them. So let's make the distinction between what a fixed and a floating rate security is. And so we can do that with kind of a simple illustration. So let's say we have a bond that we buy. So again, with these box diagrams to illustrate cash flows. An investor would think about it as anything below the line as an expenditure. So I spend 100, I get my 100 back, let's say in 4 years. And then just to make it simple, let's say once a year I get a coupon. Now what we mean by a fixed income security is literally one where the cash flow is fixed. Sorry, the pen is acting up here. And let's say that the fixed amount of the coupon that I receive by being a lender is I get interest of $5 every year. And then one time at the end, I'm going to get my $100 that I loaned back. And so that would be a fixed income security. What fixed literally means is that the cash flows that I've been promised are fixed in amount and known in advance. They don't have to be the same number. I could have had 3 in the first year, 4 in the second, 5 in the third, and 6th in the fourth year. So fixed just means I know what they are in advance. Now let's contrast that with a floating rate note, or a floating rate bond. So the idea is that just like the fixed rate bond, I lend somebody $100, they promise to pay me back $100 one time at the maturity of the loan, 4 years. By the way, when we see that all at once, the repayment of the loan happening all at one time in the future, that's sometimes called a non-amortizing loan, meaning all the cash flows that I receive before maturity are just interest. It's not partly loan repayments. But now here's the key distinction. I'm going to get a coupon payment at each of the next 4 years, but the payment I get is not going to be fixed. It's going to be a variable payment that's going to change over time according to market conditions. And so the little squiggly boxes are just an artist representation of cash flows that change over time. Usually those coupons are tied to some interest rate that changes as market conditions change over the years. It can be anything. Historically, LIBOR, the London Interbank Offer Rate, has been the primary reference rate for these variable rate coupons. So the point of a floating rate note and a fixed rate, and we'll see the difference that makes, is that they're priced on differently. Even though these are 5-year 4-year bonds, both paying coupons. The way the coupon is paid, a fixed number that doesn't change versus one that is sensitive to changes in market interest rates, is going to have a material impact on how prices for these two securities move. And we'll get into that later. I just wanted to kind of lay out the issue for you now. So we've seen where fixed income fits into a portfolio. Really, it's going to be a way of investing that's less risky, often less liquid, tends to pay or return in the form of cash flow. And we've also seen that it's a source of diversification. It's a way of getting our money to work in the market that doesn't require us to take additional risk in terms of equities. So the size of these markets is fairly enormous. We've seen in earlier work that globally there's more money tied up in fixed income investing, in lending, than there is in ownership by and large. And so these amounts are kind of staggering. So here's the fixed income markets in various economies throughout the world. And there's a couple of important things to recognize. Notice that, by the way, when it says sovereign here, think of that as the federal government of whatever country we're looking at. So there are some economies where there is virtually no corporate debt. There's quite a bit of corporate borrowing here, less so in Europe, but still around. Very little in Asian markets like Japan. Most all of their borrowing is done at the sovereign level in Japan. Also, if you look at securitized debt, asset-backed securities, you can see that's historically been almost completely a U.S.-based phenomenon. We sort of invented that market, and for better or for worse, what we did with asset-backed securities in 2008 kind of caused the global economic crisis for the rest of the world. So here are two yield curves that are relatively recent in terms of when I pulled this data. And they correspond to, well, first of all, what we mean by a yield curve is simply this. Think of it as a picture at a moment in time of what the yield to maturity is on bonds that are alike, a series of bonds that are alike in all respects, except for one, which is when they mature. So for that reason, you generally start looking at a yield curve for US government bonds, because that way you control a lot of other things, ways in which bonds could differ from one another, like having different risk levels, having different liquidities, having different call features, taxable features, and so on. So all of that is all those other factors are best controlled by looking at government bonds. But still, there's an important distinction here, that you notice there are two different government yield curves. One is called the actives curve, that's the green line at the bottom, and the other is called the strips curve, which is the blue line at the top. And let's see if we can make sense of that. So if we look at what would be the 10-year, it's not marked on the axis, but that's the 10-year bond, both the strip and the active, and those are the yields down below. Let's see if we can make sense of the difference. So what's called a par bond, or this is what was called the actives, would be the way the US government typically issues bonds. So it's a 10-year bond, but it pays interest every 6 months. So this 10-year bond would actually have 20 future promised cash flows every 6 months for the next 10 years. So for the 100 you pay now, what you're buying is a series of fixed coupons where you're going to get half of the annual promised amount of the coupon every 6 months for the next 20 half years or 10 full years. That would be structurally the way these yields represented by the green line would work. Now, by contrast, a so-called zero coupon bond, or what they call here strips, would be, again, a 10-year bond, but now one with no coupon. By definition, a zero coupon bond pays no coupon. So your price would actually be less than 100, because then at maturity in 20 half years, 10 years, you're going to get all 100 back, but you're not going to get any cash flow in the meantime. So the yield on that would be for a structure that's a zero coupon bond structure. And this is an important distinction to make, because there are actually two government bond yield curves, one for bonds that pay periodic coupons and one for bonds that don't, that pay no coupon and give you all of your return one time at the end of the life of the bond. So the point I wanted to make is that the yields on those two instruments, and the yield on a bond, as we'll see, is just shorthand for the expected return. So yield to maturity is just bond speak for expected return. Those are going to be different because the way the returns are packaged is very different. So the par bond, the yield to maturity, is going to be an average of the return that you get on the first 6-month coupon, 12-month coupon, 18-month coupon, and so on, all the way out for 10 years. So it's going to be an average of the returns bundled into those 20 different cash flows. By contrast, the return on the zero coupon bond, the strip, is going to be simply the return on getting money one time, paid to you one time, exactly 20 half years from now, 10 full years from now. So those are different numbers. And you can see, we won't go through this just now, but it's not accidental that because this yield curve is upward sloping, meaning the shorter maturity bonds have lower yields than the longer maturity bonds. When that happens, the zero coupon yield curve is going to fall above the active or the par coupon paying yield curve. The blue line is going to be above the green line, like we see it here. In one of our case problems, we'll take a look at some of the consequences of that in more detail. So now, here is the series of yield curves for not just the government curves. So this bottom line here is the government active curve. So think of that as the risk-free rate. And so again, the idea here is that the yield to maturity for a bond is just bond speak for the expected return on that bond, which we know we can always express as the risk-free rate plus a risk premium. But here's more language for you. Might as well get it out of the way. In bonds, we refer to that risk premium sometimes as the credit spread. So what you're looking at here is a series of bonds that are alike in all respects, except for when they mature, which explains the horizontal axis. But then each successive bond is a different credit class. So AAA bonds would be the line just above the government. And then above that is the yields on AA, single A, triple B, just to label it here, that's triple B. And then there's a big jump up to double B and single B. So what those credit grades represent is a indication of how likely it is that the borrower is going to be able to repay you, that they won't go out of business and before you get your money back, on the promise that they've made you. So that the list of that, a book that comes from the book is shown on the next page. What we think of as investment grade bonds are going to be bonds that have a triple B or higher rating. And speculative bonds, or what are more commonly referred to as high yield bonds, would have a double B rating or lower. So those are shakier operations in terms of their promise to repay you what they borrowed. And so you can see that as long as you are an investment grade borrower, your risk premium is going to be relatively modest, something on the order of like 80 to 100 basis points. Remember, the risk premium for equities was like 5 to 9%. So again, bonds are a lot less risky, and so your risk compensation tends to be a lot less until you get up into these lower credit grades, where there's much more of a possibility that the investor is not going to be able to repay you. And we'll talk more about that as we go along. In fact, a lot of bond investors, if the credit grade on the bond gets low enough, like down into maybe the C range, they actually think of that as being more equivalent to owning a stock in terms of the risk exposure and the compensation that they're going to demand. So let's talk about valuation principles for the rest of the class. And this is going to be the rest of today's recorded lecture. Valuation, a couple things to note. First of all, we're going to follow exactly the same model that we did with stock. In other words, we're going to make the economic argument that what something is worth today is the present value of the cash flows we're going to receive into the future. But there are a couple of things that are going to make this a lot easier for us. Primarily, by definition, what we mean by a fixed income bond is that these cash flows are fixed. So we'll assume in most of our work that we have fixed cash flows. In other words, the issuer tells us it's going to pay us a coupon of 5% a year for the next 4 years. And there's going to be a finite maturity, meaning that this isn't an open-ended problem like it was in stock. There will be a time when this bond matures and pays us our original principal back. And so that's going to make valuation fairly simple. I mean, to use the terminology we did last time, there really aren't going to be any numerator issues at all in terms of valuing bonds. So at the most basic level, what we can do is take these fixed cash flows then and discount them back to the present at a zero coupon rate that is specific to when each cash flow is timed to come to us in the future. So we could use those strip yields that we looked at before. The blue line would be the zero coupon yields for each different cash flow point in the future, 1 year, 2 year, 3 years, and so on. So as an example, if we take a simple bond that pays a 9% coupon, so there's a list of the payment dates. Let's make it simple and say that pays annual coupons. So we get paid 9 in the first year, promise of 9 in the second, and so on. And then in year 5, we get our last $9 interest payment or coupon, plus we get our $100 principal loan back. So if these are our strip yields or our zero coupon yields, then the way we could value this bond is very simple. We would just take the present value of 9 in year 1, discounted at the 1 year discount factor, the 1 year yield to maturity, the zero coupon yield. The 786 is the present value of receiving $9 in year 2, discounted for 2 years at 7%, and so on. And so we add it up, go through the whole process. It's very mechanical. Again, we're not having to project cash flows. That makes it very simple to do the algebra here. And we end up with 103.99. So this is a bond that we're going to call in a second a premium bond. It's a bond that actually sells for more than its par value of 100, now for reasons that we'll see. So that's kind of technically the way we think about pricing a series of future cash flows, is to use a date-specific discount rate applied to each point in time where a cash flow occurs. If you were, and some of you may be going to work on a trading desk for a Wall Street firm, this is the way you're actually going to think about valuing bonds, or valuing really all cash flows as well, using date-specific discount rates for each cash flow, for a variety of reasons. But for most bond investors, that is kind of overkill to use 5 different discount rates for one bond. Instead, what the yield to maturity is simply the single discount rate that I could apply to those same cash flows and come up with the same answer. So what single discount rate would set the present value of the future cash flows equal to the price of the bond, that 103.99 in this case? And let me designate that by the letter I in this case, and that's what we call the yield to maturity. And so it's the same concept you might have seen in work in corporate finance as what's called the internal rate of return. And so here's an example of valuing the same bond, the same cash flows into the future with the same payment dates, but we'll let each of those cash flows now be calculated as a single, using a single discount factor. So 9 discounted for 1 year at 8% is 833. The 772 would be the $9 I'm receiving in year 2, discounted at the same 8%, but for 2 years, and so on. And again, we established the 8% in order to get the 103.99. Let me show you really quick. Well, I want to show you a couple things on the bond spreadsheet, the bond valuation, because there are different tabs on here that we'll go through. And the first one, the simplest one, just says price and duration. We'll talk what duration means later. But just to show you that this is designed to value a bond as simple as the one in this problem. So if I change the coupon rate to 9%, it's already a 5-year to maturity, making annual payments. And so the only other thing to do is to change to 8%. And you can see here's the 103.99. In fact, 103.9927 to be precise would be the price of this bond. So your handheld calculators can do this fairly simply too, but there is a spreadsheet that's designed to calculate all the analytics, and you can see there's more information below the price, and we'll make sense of that in our next lecture. So let me go and say a couple more things about the valuation process. What we've just shown is that really we have 2 ways for any fixed series of cash flows. We have 2 ways we can think about calculating what it's worth today, the 103.99. We could use a date-specific discount rate, so a different discount factor or expected return for each point in the future. Or we can look at a single number that sort of summarizes what's going on with those 5 separate zero coupon rates. By the way, when we do the latter, when we use a yield to maturity as kind of a shorthand for what's really happening at 5 different points in time in the future. So we want a single number rather than 5 different ones. Notice that yield to maturity has to be some sort of an average of the underlying zero coupon rates. So it's not an accident that the 8% falls somewhere in the range between the lowest zero coupon rate, the 6%, and the highest, 8.13. And that's something we'll talk more about as well. So just let me lay out a little bit more on the language and a few more valuation concepts to wrap us up. A bond that sells, so here's the kind of the picture of the bond. We have the price we pay today. We have coupons, let's call them C. I'll put it underneath here. And then the face value is what we get at maturity. And so we have 3 relationships to understand between the price and the face value of the bond. What's called a current coupon bond, or usually referred to as a par bond, is when the price and the face value are the same. So you pay 100 today, you get paid back 100 at maturity, refunding your principal, and in the meantime, what you get are the coupons. So in that case, if you think about the difference between price and face value is your capital gain. So if that's 0, then what that means is, remember, when we say yield to maturity, that's shorthand for the expected return on the bond. That's your overall return on the bond. Well, if you're not getting any capital gain or loss, P and F are the same, then all of your return is coming in the form of cash flow. So bonds are generally designed to be issued when they're originally issued. They're issued at par. So on the day they're issued, bonds are generally set up so that 100% of your return that's promised is coming in the form of cash flow, of coupon. Now, we looked at, secondly, a premium bond as an example a second ago, and that's one where the price is greater than the face value. So we pay $103.99 and we get back 100. So you say premium, that kind of sounds like it's a good thing, but in this case, what it means is you're going to have a capital loss built in. You pay about 104 and you only get back 100. And the reason for that is you're getting a coupon that's actually higher than the overall expected return. In that case, this bond was paying you a 9% annual cash flow in a market where you only had the right to expect an 8% return. So that's going to get bid up. That's a valuable thing. It's going to get bid up to a price that's above the face value. So the higher than normal coupon, 9 versus 8, plus the capital loss is going to average out to the expected return, or the yield of 8 in that case. So a discount bond, on the other hand, works exactly the opposite. It's a bond that has a price that's below the face value. And so in addition to whatever coupon interest you're getting, you're going to also get a bit of a capital gain. So the two together are going to give you a higher yield to maturity than the coupon rate is alone. And so a discount bond is one where you get both sources of payment, you know, the coupon plus a bit of a capital gain. And so a zero coupon bond is just sometimes what we call a pure discount bond, where the coupon rate is 0. So all of your return comes in the form of capital gain. So let's get used to thinking about bonds that are either par bonds, bonds trading at a premium, or bonds trading at a discount. Here's an example of a discount bond, and it's actually more of a relevant example in terms of the way bonds are actually priced, or at least as they were a couple of years ago. So here's a 7-year Treasury bond paying a coupon of 6 3/4 annually, but of course that's going to be not a 7-year bond, but it's really going to be a 14 period. So remember, Treasury bonds and US bonds in general pay coupons semi-annually. So 6 3/4 would actually, a year would actually be half that every 6 months for 14 half years rather than 7 full years. And so then the price we're given is 98.125 relative to a par value, a face value of 100. And most bond pricing problems are set up to scale to a face value of 100 just to keep the math kind of straightforward. Now, the one thing I wanted to point out is on all of these bond pricing problems, there are ultimately 5 pieces of information that you need to know. You need to know the present value of the bond, the yield to maturity, the face value of the bond, the coupon payment, and the number of payments, which is also when in the future the bond is going to mature. Now, generally, the bond contract is going to specify those last 3. And so those won't change, at a given moment in time. You'll know the face value, you'll know the coupon rate, you'll know when in the future the bond matures. So the trade-off here is if you know the price, you can calculate the yield to maturity. Or if you know the yield to maturity, you can calculate the price. So we showed in a previous example the latter, where we had the yield of 8% and what was the price of the future value, what was the present value of the future cash flows. So let's flip it around. So if we know the if we know the price of the bond today is 98 and an eighth, 98.125, then what we're solving for is the discount rate or the internal rate of return or the yield to maturity. Those are all kind of loose synonyms here. And so what we have is, again, we'll see how we can do that with calculators. There's no closed form solution for that. But plugging that into something like an HP12C or there's a spreadsheet I'll show you, we'll talk about that more on the next lecture. The answer in this case would be 3.5472, but remember that's going to come geared to how you defined your period. So that's per half year. Our convention is we always want to express interest rates on a full year basis or an annualized basis. So take that 3.5472 and double it, and that's the 709. So this bond's yield to maturity would be 709. So notice that's higher than the coupon rate. And the reason is, in addition to getting coupons of 6.75, you're also getting a slight capital gain over this 7-year period as well, as the bond goes from 98 and a quarter, or an eighth, I should say now, up to 100 at maturity. So valuing bonds is fairly straightforward. There is one wrinkle that we need to talk about, and that's the idea of valuing a bond between coupon dates. And we're going to go through this in much more detail in the case problem that will work in class. But the idea is the following, and let me just kind of talk you through an example from the book so we can see how it works. Unlike dividends, if the cash flow associated with the stock is a dividend, of course, and the way dividends work is we either own the stock on a particular day or we're not the owner. And if we own the stock on a day and a dividend's announced, we get all the dividend. That's not the way bonds work. Bonds, as a lender, you're entitled to interest for every day that you were the lender of record. And so if we sell a bond between coupon dates, then we have a little bit more hoop jumping to do to figure out how to value the bond. And we'll see why. So this is an actual bond that is still in existence and will be for about another year and a half. It matures in October of 2022. We're going to value this as of the end of June in 2017. And it pays interest coupons in April and October. So at the current moment, the price of the bond is shown to us, and right here of the 101.115. And so let me talk about the process for doing this, because it's not hard, but it's a little bit more hoop jumping, as I mentioned before. So here's the idea: we want to buy this bond. Let's say we want to buy this bond from a seller today on June 29th. The last time this bond paid a coupon was about 2.5 months ago, in the middle of April. The next time it's going to pay a bond is in October. So this much of the time that's passed belongs to the other party that's going to be selling us the bond. They were the ones who were the lender. And we're entitled to the coupon for the rest of the time from when we take over the loan to the payment date. So here's what's going to happen. It would be nice if we could call up the treasurer of the company and just say, hey, listen, next time you pay us a coupon in October, split it up so they get 2.5 months and we get the rest. But that's not going to happen. They won't do that for us. So here's what is going to happen. When I buy the bond, or we buy the bond from the other party, we will have to cash them out and pay them their coupon up front. And then when the time comes in October to receive the coupon, we'll get the whole 6 months. The convention in bond markets, by the way, is that you always get paid at the back end of the lending period. So the payment in October covers the prior 6 months of lending. So it's a 3-step process. None of it's hard, but it's just something we have to keep track of. The first thing to do is we're gonna calculate hypothetically using today's yield to maturity. And again, that was given to us in the problem here. The yield to maturity right there, and the price was actually the 101.258. So using today's yield to maturity, we're going to go back to last April, the last time it paid a coupon, just so we can be on a coupon date and we don't have to worry about anything. And we're going to calculate the hypothetical price of what this bond would have been worth then using today's rate. So this isn't the actual price on that day. This is what the price would have been using today's date. So then next we're going to take that and bring it forward in time to today, saying, well, if we just invested that amount, 101.3, for what turned out to be 74 days out of a 180-day period, then that would be worth 101.7719. Now that number does matter. That's called the total invoice price of the bond. And what that represents is the amount I'm actually going to have to pay to the seller to buy this bond today. But that represents two things: what the bond is worth plus the interest that I have to cash them out with. So then the next step is to figure out my accrued interest, which is the AI in notation there. And that's pretty simple. So the interest here is 2.5% a year, or 1.25 every 6 months. And it's just going to be a straight line calculation. So there's nothing fancy about the calculation. They held the bond for the first 74 days of this 180-day coupon period. So that's how much of the coupon they deserve, the 51 cents or thereabouts. So then the actual value of the bond is going to be the total invoice price minus the accrued interest. And sometimes that's called the flat or the clean price of the bond. And that's the 101.258. Now, let me just show you for reference, and we'll work a problem in class in the case problem with this. But I've designed a tab in the spreadsheet to do these sort of complex valuation, bond valuation between coupon date problems. So we put in our current date of reference, the last time it paid a coupon, the next time, when it matures, the yield to maturity of the bond, and the coupon rate. And then what you're going to get as output, among other things, is the invoice price, how much of that is coupon, and then what the bond itself is actually worth. So again, mechanically, once we understand how to go about it, we have technology that'll help us do that. So let's get to a good stopping point for today and talk about just a couple more things. So there are many sources of bond risk. So when we talk about risk, what we're really talking about is what could go wrong when you make an investment, as we've seen throughout the semester. And so one is that you don't get paid back what you were promised. That's default risk. That's what those credit grades are intended to do, is to give you a sense of that. The second is interest rate risk. In other words, interest rates can change after you buy a bond, and that could have an adverse impact or maybe a beneficial impact on the price of the instrument. And then there are other things like bonds can be called, liquidity can change, taxes, and so on. But let's concentrate just on the default risk and the interest rate risk. So here's what we know about the relationship between bond prices and interest rate movements. So just to make it simple, let's kind of remind ourselves of this simple schematic. We have fixed cash flows, and now let's call it I as the yield to maturity. So what we want to do is to think about what's going to happen to the price of a bond when interest rates, let's say, go up, to make it simple. So if the interest rate goes up, the first fact is that the bond price tells us that the bond price is going to go down. So it's going to move inversely with the rate movement. So think of this as the direction effect. So if rates go up, prices fall. And the reason for that is pretty straightforward. Again, let's get in the habit of thinking of the yield to maturity on a bond as a shorthand language for the expected return. So the overall return for the bond is now higher. Well, how many ways can you get paid? Remember one of our fundamental facts. Well, there are only two, right? Cash flow and capital gain. But the whole idea of a fixed income bond is, by definition, we're fixing the cash flow. So if investors demand a higher return and they can only get it through capital gain because the cash flow is fixed, then the price has to fall to create a bigger capital gain. Remember, one of the other cash flows that's fixed is the face value at maturity. So that's the reason. That's very simple thinking, but that's the reason for the direction. 2 and 3 collectively as facts refer to kind of the relative magnitude. And the idea is this. Every fixed income bond, when interest rates change, will see its price move in the opposite direction. But not all bonds are going to be affected the same way. And what fact 2 tells us is that if we have two bonds with the same coupon, the bond with the longer term to maturity will be more sensitive. So a 20-year bond would see its price move by more than a 5-year bond. And then flipping it around, the lower the coupon rate for bonds that have the same maturity, we're going to have more sensitivity in the price. So if we have two 10-year bonds, the one that pays a 5% coupon will see its price respond to any interest rate movement more than a bond paying an 8% coupon. And we'll see that practically in a second. Fact 4 is the convexity effect. I'll explore this more later. But what it really tells me is the relationship between bond prices and interest rate changes is this curved or convex line. So if rates start at 8, and let's think of them either going down to 7 or up to 9, what this tells me is that the price increase for a rate decline, in other words, rates go from 8 to 7, it'll do more to help prices than prices would get hurt if rates went up by the same amount from 8 to 9. And that's called convexity, after the shape of the curve. In other words, it's not a straight line trade-off. And we'll talk more about that when we talk about strategy as well. So let's just wrap up with a really quick example, and this will set us up for where we want to pick up next time also. So here are 3 bonds with different coupons and different maturities. There's a downward sloping yield curve in this case. Sorry, this pen is kind of driving me nuts. So here are the yields, and here's the maturity. It looks something like that. And so the question is, when interest rates change, let's say they go up from, so we had a shift up in the yield curve, let's say. We know all these bond prices will fall. So the first thing I did was just calculate the prices of those bonds under those conditions. And let's see if we could predict what we would think would happen. So we would think that all of the bonds will go down in price, but bond A is going to go down by the least because it simultaneously has the highest coupon and the shortest maturity. So its price will fall if rates rise, but by less on a percentage basis than any of the others. Bond B, on the other hand, is going to be the most sensitive to an interest rate movement because it has the longest maturity of these 3 and the lowest coupon. And then C would be somewhere in the middle. And if we just reprice these bonds and then express them as a percentage price change, with say, I'm just assuming interest rates increase across the board by 0.5% or 50 basis points, then we see exactly what we predicted. So these facts about the relationship between price movements for bonds and interest rates are useful because they're going to actually let us predict in advance which are going to be the most sensitive or the least sensitive. Now, here's the problem. If we come up with another bond, and let me just pick numbers. Let's say this is a 6% coupon with a 19-year maturity. We have a little bit of trouble now because it's going to, relative to bond B, it's going to have a higher, a shorter maturity, and also a higher coupon. So we would think that it's going to be unambiguously less sensitive than bond B. But what about relative to bond C? It has a lower maturity, which would make it a little less price sensitive than bond C, but it has a lower coupon, which would make it a little more. So we have the coupon fact and the maturity fact in terms of the magnitude of the change at conflict with each other. So we can always do the calculation, and in this case, we can see that this bond would in fact be a little bit more sensitive in its price change than was bond C. But we weren't able to predict that in advance. And so what we're going to come up with next time is another statistic for our valuation toolkit called bond duration, which is going to allow us to make that assessment very quickly and very cleanly without computing prices to find the answer like we just did.